Hello everyone, this is Kimberly Biana on a special report. Have you or anyone you know asked or wondered how wealth builders build wealth? How is it that some folks start from very humble beginnings and are able to build generational wealth? Wealth building is not as complicated as one may think. Like anything else, wealth building requires a formula, a process, and consistency. Today we are going to start a short series of videos that are aimed at exploring a handful of financial products designed to grow money with zero risk. Welcome to Growing Money. Our research has found that individuals with a net worth higher than $1 million report 7 or more income streams on their taxes. It is safe to say that wealth builders are not working a 9-to-5, Monday to Friday job. We all have 24 hours in the day, and we all require sleep. What is different? For starters, wealth builders implement some simple rules. For security, they implement the 10-20 rule. To see how fast their money is growing or going to grow, they implement the rule of 72. To manage spending, wealth builders implement the 50-30-20 rule. These rules are minimum guidelines and can be manipulated depending on how aggressive you want your wealth building initiative to be. Let's dive in and explore the 10-20 rule. Just like everyone else, wealth builders have emergencies. After all, life delivers ups and downs to everyone. Wealth builders also understand that they can't work forever. Eventually, no matter how strong or healthy you are, you will not be able to work. In addition, wealth builders know that there is no minimum age required to retire. Retirement is 100% dictated by whether or not you have enough money to live on for the rest of your life. This is why they implemented the 10-20 rule. Wealth builders begin by saving 10 times their monthly income. This becomes their emergency fund. To secure their future, they know they have to accumulate 20 times their yearly salary to support themselves when they can't work any longer. If you want to retire early, you have to be more aggressive with this rule. For every extra year you want to be retired, you will need 18 months of additional salary saved. This simple equation protects you from inflation, taxes, and a few other financial threats to your retirement funds. The most expensive thing in life is time. There is no replacing it. There is nothing you can do today to get back the last year. Wealth builders understand how important this is. They know that when markets crash, it takes time to recover losses. Time they can't get back. They also know that in order to know if they are building the wealth they desire, they need to know how fast their wealth or money is growing. Wealth builders implement the rule of 72 to see how fast money is growing or how fast it will grow when investing in an opportunity. For this rule, you take 72 and divide it by the percentage rate of return of your investment. The result will be the number of years it takes for your money to double. Let's run a quick example. Previous generations instilled in their kids to open a savings account and save money. Traditional banks today yield 0.01% to 0.05% interest on a savings account. If we take 72 and divide it by 0.05%, this means it takes 144,000 years for our money to double. In addition, normal inflation is about 3 to 4%. If you are earning 0.05%, but your money is depreciating at a 3% rate, you are losing 2.5% by parking your money in a savings account. Wealth builders know this and keep very small balances in the bank. Always remember this. In wealth building, if it doesn't make money, it doesn't make sense. The 50-30-20 rule is used to help manage or control how wealth builders spend their money. Wealth builders know they need to have high credit scores, so they leverage credit with only this objective in mind. As for their spending, they compartmentalize their spending. 50% is allocated to addressing their needs. Needs are things you need to live. Food, shelter, clothing, gas, etc. 30% is allocated to purchasing things they want. The new iPhone, travel, a fancy car, etc. 20% is allocated to savings or growing your money. This rule can be manipulated to be more aggressive in investing depending on how aggressive you want to be about growing or building wealth. It is important to note that wealth builders usually do not invest more than 5 to 10% in high-risk investments. This is also dictated by age and risk mitigation. For many years, wealth building opportunities have been discussed among certain circles. These opportunities were not easily available to most people. Today, we are in the age of information, with the help of technical advances, the internet, and the current AI revolution. Many of these financial products have become available to the masses. Wealth builders know risk carries a price, and usually, even though the monetary impact can be resolved, the time factor cannot. For decades, wealth builders have leveraged zero-risk investments to secure their growth, and only leveraged high-risk investments, much like a race car, would use nitrous oxide for short and superfast speed. Typical zero-risk investments include bank CD. CDs guarantee a fixed interest for a specified time frame. Multi-year guarantee annuities are just like CDs. Also known as NQIA, offers guaranteed interests for a specified number of years. Only these are invested with insurance companies and usually offer a higher rate of return. Non-Qualified Index Annuities, also known as NQIAs, provide the ability to grow when the markets go up with zero risk of market losses. In addition, these types of accounts protect you from taxes, while providing you with additional benefits. Qualified index annuities are much like non-qualified index annuities with one exception. Once these annuities are dispersing income, or surrendered or chased out, they are fully taxable. QIAs also grow with the markets but do not absorb any market losses. For the purpose of this presentation, we will take a look at the power of the NQIA. For this example, our subject will be a male, 38 years old. Their initial investment amount is $40,000. We are going to explore the power of Fidelity and Guaranty's Accumulator Plus 10 non-qualified index annuity. From the left to the right, you will see the following columns: contact year, age, premium, account value, interest credited rate, surrender value, and death benefit. In year 1, the first row, we can see under premium the initial deposit of $40,000. Now let's drop down to year 10 rows down. Let's fix our eyes on the surrender value column. You will see the value of this account is now $96,993. Under the column death benefit, you will see a death benefit of $99,684. In 10 years, this person would have doubled their money. Let's now look at what happens in 20 years. We still see the deposit has not changed. It is still $40,000. Under the surrender value, you will see that column is not $256,505, and the death benefit is $256,505. In 20 years, you have taken $40,000 and generated 6.41 times that amount. How do we forecast this data? This projection is calculated using over 10 years of historical market performance data. Now let's see what happens if we do nothing else, and just let this account continue to grow on its own for 30 years. Under the 30-year row and the column premium, you will see that this value has not changed at all. It is still $40,000. If we continue to the right, you will see that under the surrender value column, the value is not $676,891. The death benefit is $676,891. If we move down another 10 years, you will see the surrender value is not $1,820,315. The death value is also $1,820,315. If we let this account continue to grow for another 10 years, under the account surrender value, this account is forecasting for $1,962,353 with the same amount in the death benefit. It is important to note that historical performance doesn't guarantee future performance. What this means is that there may be a year where the growth is a little less or a little more. However, one thing is 100% certain. This annuity will never lose money, and it will never lose what it gained. In addition, the death benefit ensures that if you pass, your family will receive the initial investment plus all the gains. This account is also flexible in that it allows you the opportunity to add money if you want to. In any given year, it allows you to use up to 10% of the balance without any penalty charges. After the initial 10 years, you can choose to take money out as an income for life or in disbursements. Savvy wealth builders simply continue to grow wealth. The non-qualified index annuity is just one of many dynamic financial tools used to build financial strategies. These tools, in combination with the rules discussed earlier, give savvy wealth builders the edge they need to secure wealth. Let's recap. NQIAs have zero risk of market losses. They compound interest based on index performance. Your principal is secured. You never lose your gains. This product combines the best of both worlds. Aggressive gains with zero risk. The Financial Intelligence Agency has secured funding and has launched its initiative to end poverty in the U.S. For a limited time, while funding is available, the Financial Intelligence Agency is extending financial literacy courses at zero cost. We have partnered with communities, HOA organizations, apartment complexes, and nonprofit organizations to deliver these resources. If you are interested in bringing these resources to your community, you may request information via the link in the video description. The national team at the Financial Intelligence Agency will also develop custom financial strategies for you and support the implementation of those strategies at zero cost. If you are interested in leveraging these resources, you may request information via the link in the video description box. Finally, the Financial Intelligence Agency will monitor your strategy to ensure your strategy adjusts to your life changes. This will ensure your strategy is always on track to your desired result. To get started, click the link in the video description and request your initial consultation. If you do not want to miss any additional resources, make sure to subscribe. It was a pleasure presenting to you today. Remember, wealth is simple to build. You just need a formula and a few rules. There is a team in place ready to help you. This is Kimberly Biana signing off.